While the retail market fixated on a Nasdaq slide and TSMC hitting a technical sell rule, institutional capital quietly repositioned. This isn't just daily noise, it's a critical structural rotation underway. The core question is, what fundamental shifts are driving capital from high-growth tech toward defensive giants like Abbott Laboratories? Let's unpack the deeper implications. First, let's understand TSMC, the titan of the semiconductor world. Their moat isn't just size, it's their foundry model. They don't design chips, they manufacture them for everyone else: Apple, NVIDIA, QCOM. This positions them at the nexus of nearly every technological advancement. Their core value proposition is unparalleled precision, scale, and proprietary process technology, making them irreplaceable for advanced chip production. But that is only part of the story. Now, let's look at Abbott Laboratories. They operate across 4 diverse segments: medical devices, diagnostics, nutrition, and established pharmaceuticals. This diversification creates a powerful defensive moat. Demand for their products, pacemakers, diagnostic tests, baby formula, tends to be resilient, insulated from economic cycles. They provide essential goods, not discretionary ones, which is critical in a volatile market. Here's where the broader market metrics become interesting. While we don't have specific new quarterly results to dissect right now, the Nasdaq slide signals a broader slowdown in top-line growth for many tech-heavy companies. Post-pandemic demand for electronics has normalized, and higher interest rates make future growth prospects less appealing today. This impacts sectors reliant on discretionary spending or aggressive expansion, tightening margins for many high-flying names. That leads us directly to TSMC. The sell rule isn't just about valuation, it's also about anticipating cyclical shifts. While TSMC's technology leadership remains strong, their revenue and margin expansion are tied to the global chip cycle. When smartphone, PC, or server demand slows, so does TSMC's factory utilization. This creates a challenging environment for near-term revenue growth and puts pressure on their traditionally high operating margins. Now look at how TSMC's management is navigating this. Their execution strategy revolves around long-term capital allocation. They continue to invest tens of billions into new fabrication plants, despite short-term market fluctuations. This isn't about today's earnings, it's about solidifying future technological dominance and geographic diversification. They are playing a multi-decade game, preparing for the next wave of computing and AI demand. The next signal comes from Abbott's capital allocation. Abbott's management consistently focuses on innovation, strategic acquisitions, and predictable shareholder returns. They prioritize R&D in high-growth medical areas like structural heart or diabetes care. This targeted investment ensures a pipeline of new products, while their dividend policy provides stability. Their strategy aims for consistent, defensible growth, which appeals during uncertainty. That leads us to a bigger question regarding the industry context. The macro environment of higher interest rates and persistent inflation is a major headwind for many Nasdaq components. Growth stocks, valued on future earnings, see their present value diminish when discount rates rise. This isn't just a market correction, it's a fundamental repricing of risk and growth expectations across the tech sector, forcing a competitive re-evaluation. The global chip dynamics add another layer of complexity for TSMC. The sector faces significant geopolitical pressures, particularly concerning Taiwan's role in global supply chains. Furthermore, the industry is incredibly competitive, with players like Intel and Samsung constantly pushing boundaries. While TSMC holds a leading position in advanced nodes, the cyclical nature of demand and geopolitical instability create persistent challenges. This brings us to TSMC's structural risks. Beyond the obvious geopolitical vulnerability, there's the intense capital expenditure required to maintain technological leadership. Each new generation of chips demands more investment, creating significant capex pressure. Should global demand falter or if a competitor truly closes the technological gap, TSMC's core moat could face unprecedented challenges, impacting its multi-year thesis. Conversely, Abbott faces different, yet equally material, risks. The healthcare sector is heavily regulated, meaning constant scrutiny and compliance costs. Pricing pressure from governments and insurers can also impact margins. Furthermore, while diversified, their growth depends on continuous innovation. A failure to develop next-generation products or adapt to changing medical standards could slow their momentum. It's about navigating a regulatory labyrinth. The forward outlook for tech, particularly Nasdaq components, involves a recalibration. We're moving from a period of easy money and hypergrowth to one where structural innovation, efficient capital deployment, and real profitability matter most. This means investors are reassessing valuations, favoring companies with strong free cash flow and a clear path to sustainable, rather than speculative, earnings visibility. This shift creates opportunities, but demands patience. Looking at the multi-year thesis for TSMC and Abbott, we see contrasting asset insulation. TSMC remains indispensable for leading-edge technology, but its cyclicality and geopolitical exposures are significant. Abbott, while facing regulatory headwinds, offers robust insulation through essential products and diversified revenue streams. This is why we see capital rotating towards defensive strength when growth becomes uncertain. It's about where the smart money finds safety. So, what does this mean for tactical positioning? We're seeing structural momentum building in defensive sectors like healthcare, potentially putting names like Abbott on breakout watch as capital seeks insulation. Conversely, for certain high-growth tech exposures, particularly those with significant cyclical components, we might be looking at trim consideration for near-term overbought structures or shifting thematic tailwinds. It's about managing risk and reward in a dynamic environment. The market is sending clear signals. Understanding these structural shifts, not just daily headlines, is crucial for building resilient portfolios. For deep dive institutional analysis that unpacks these complex dynamics and identifies where smart money is truly moving, ensure you're subscribed to SRMoneyNews. Hit the like button, share this video, and ring that notification bell. We'll continue to bring you insights that matter for your long-term success.